I want to spend some time talking to you about one of the biggest misconceptions when it comes to tax planning. In this video, I'm going to explain why 401ks and traditional IRAs are not tax planning strategies. Unfortunately, conventional wisdom taught us that we should defer and maximize contributions to our 401ks every year and put as much money as possible into retirement plans on a pre-tax basis. Not only is this way of thinking outdated, it's really just pure wrong from a tax and investment standpoint. If you don't believe me, look at what the other thought leaders out there in the industry say about this. There are very few of us who focus our careers on tax planning strategies and building wealth. However, those of us that do all collectively agree that 401ks and IRAs are not the way to go. You never read articles about billionaires having a bunch of money stashed away in 401ks and IRAs. Rather, you do sometimes see articles about Peter Thiel or others who have a bunch of money inside a Roth IRA. So I do want to make the distinction that I don't like retirement vehicles like 401ks, IRAs, SEP IRAs, where you're contributing on a pre-tax basis and have to pay tax when you take money out. But that is to be distinguished from other types of retirement plans like Roth IRAs, which I do very much like. And if you watch my other videos, I talk to you about how to use a Roth IRA and how those can be great wealth building strategies and great retirement accounts to save money in. So when I'm talking about retirement accounts and bashing them, I'm only talking about the 401k, IRA type of retirement accounts. I do like Roths, and I do think they can be a great vehicle for building wealth if you know what you're doing and know what to put in there. So with that said, let's go ahead and dive into the specific reasons about why I do not like 401ks and IRAs. So at the start, I want to debunk the myth that they save you taxes. They do not save you taxes. If you contribute $100,000 to a 401k and then take that $100,000 out years later when you retire, you are paying tax on that. And you're paying tax is treated as the same type of income. So this idea that you can make a bunch of money and build a bunch of appreciation inside a 401k and avoid tax, that is not true. If tax rates today are the same as the rate you pay when you retire and start having to take these distributions from these accounts, if those rates are the same, all else is equal, and you're not any better off by putting that money inside that account and deferring the tax bill to the future. So, for one, that's just the idea that you're going to be paying less tax in the future is based on a lot of, I think, assumptions that we don't know. So for one, I'll talk a little bit more in a few minutes about why I don't think tax rates will be lower in the future. Also, you have no clue what tax rate bracket you will be in the future. So you're basing this on a lot of assumptions that you don't even know if they're right or wrong and what your situation will be 20, 30, 40, 50 years down the line when you do retire and when you're required to start taking these distributions. Secondly, not only do we not know what tax rate and bracket we'll be in, we also have no clue what the situation will be around retirement plans. Will the IRS force us to start taking distributions sooner because they don't want people having a bunch of money inside those plans? There could be law changes. We've seen, some Democrats in Congress want to attack the Roth IRAs. So what would just stop them from coming after 401ks and IRAs for those of us who have a bunch of money inside those accounts? Also, what I see happen a lot is when I used to have a consulting firm, I worked with a lot of clients who were close to retirement age or past retirement age, and they were actually forced to take mandatory required minimum distributions every year that were so high because they had unfortunately so much money inside these accounts that they were in the top tax bracket. So the idea that you're going to have a reduction in taxes is based on, I think, a lot of flawed assumptions that could turn out to be all wrong in the future. Also, a lot of people make the statement that, well, you get to, avoid paying any tax on the appreciation of whatever assets are in that retirement account. Well, yeah, that's just a deferral, but at some point you've got to pay tax on that and you've got to take distributions at some point. So somebody somewhere is going to be paying tax on whatever the gains are in that account. So it doesn't really matter that the gains are being made tax-free because you've got to pay tax, and you've got to pay tax at a very unfavorable rate in the future when you do take that money out. Also, any gains that you're making on that money would have been capital gain and at a lower tax rate if you own those assets outside of the accounts. But unfortunately, they're inside your 401k or IRA. So when you do take distributions, whatever the character of that gain is, which is most likely to be capital gain, that's going to be taxed at the high ordinary income rate. So that's one of the many reasons that I think it's a flawed myth out there that there are tax reductions from using these accounts. There are not. And it's all based on this assumption that financial advisors tout that, well, you're going to be in, a lower tax bracket when you retire, and you're going to be making a lot less money. Well, for one, is that true? How can you say that? Because you have no clue what tax rates will be and how much money you have. And secondly, why would you ever entertain a wealth building strategy that led to you thinking that you're going to have less money and be making less money when you retire? So I don't really subscribe to that line of thinking. It doesn't make a lot of sense to me. And I don't think, I think it's based on a lot of flawed assumptions. So that's the first reason I hate these accounts, is that there is no tax reduction. Anyone who tells you that doesn't really understand how these accounts work. Secondly is that, and I touched on this before, you can only make contributions to these accounts with what's called earned income. So that's basically salary income. And one of the reasons I hate this is that it incentivizes you to have a higher salary. So if you're a business owner, for example, I see CPAs actually tell their clients to increase the salary that they pay themselves from their company so that they can increase their contributions to these accounts. That is absolutely terrible tax planning advice. You pay the highest tax rate on salary income or earned income, whatever you want to call it, than any other category of income. You pay the highest ordinary rates under federal and state law that apply, and you also pay payroll taxes, which are terrible. People ignore payroll taxes. They don't even know they're paying them, but they're terrible, and they really, really add up as you start to make more and more money. So anyone who tells you to increase the earned income you make in order to make a contribution to these retirement accounts, please get rid of that CPA. That is really bad advice. If you're a business owner, you want your salary to be as low as possible. You actually are getting what's called the qualified business income deduction right now, which is just a straight 20% deduction against all your net income of your business. So the effective rate, the highest effective rate you should be paying on business income is 29%. So you're actually getting a break under current tax law on that net income, and you don't get that break on salary income. So not only are you paying payroll taxes on your salary income, you're paying a much higher effective tax rate on that because you don't get that qualified business income deduction on your salary income. So I never understood why, people tell you to increase your salary. If you're a business owner, don't ever listen to that. That is a really bad idea. You want that salary to be as low as possible, even if that means you can't make any contributions to your retirement accounts, which if, at the end of this video, hopefully you understand why you shouldn't be doing that anyway. Let's say you are an employee of a company and the only way you can really make money is W-2 wages, is a salary. Well, I know you can't really tell them, pay me more in a way that's more tax efficient. That's unfortunately the only way you're stuck. But just understand, if you are an employee, you might think you're making a great salary, but chances are good that you're paying almost 50% of that to the government in some form or another. And in a lot of cases, you don't even know you're paying it. You're paying taxes on that money when you are. So just keep in mind that whatever you're, contributing to your retirement accounts with, that is really inefficient income that you've made and made that contribution with. So the reason I have this on there is that if for some reason you're a business owner or otherwise have a way to structure the category of the type of income you earn, the last thing you want to do is make that earned income. So the money you are putting into these retirement accounts is the least efficient income you could have possibly earned. And you are still paying payroll taxes on that money, even if you do put it in the retirement account. And what happens is on the back end, when you take it out, you're taxed at that same really bad rate. So that ordinary income rate that would have applied to the money you're getting now if you hadn't put it in the retirement account, you're going to pay that in the future. So long story short, distributions from 401ks and IRAs are also the least efficient type of money you can make. Yes, you might be taking that distribution later and paying tax later than you would have if you hadn't done it, but you're still paying at that terrible rate. So you haven't really done anything from a tax planning strategy standpoint. Also, there's nothing you can do to reduce that tax rate. So when I'm 65 or older, I can tell you I probably won't still be operating a lot of businesses and having a lot of deductions. I probably won't be actively investing in real estate at that point. So there's very little you can do from a tax planning standpoint to reduce the tax rates and tax you have to pay on distributions from IRAs and 401ks. So you're just kicking the can down the road to when you have a lot less flexibility from a tax planning standpoint. Whereas now that I'm, younger, and those of us in our 30s and 40s and even our 50s, we're happy to go out and buy businesses. We're happy to invest in real estate and be more active with respect to our investments in our businesses. And those are strategies that can be used to reduce your taxes. Those strategies are not going to be available to most of us when we're older and retired and don't have that same energy. So you are making money and putting that money into those retirement accounts. That is the least efficient type of money, and that same lack of efficiency on the tax rates that you're going to have to pay still apply when you take those distributions in the future at retirement age. I touched on this one before, but not only are tax rates likely to increase, they will increase. If nothing else happens, then we know tax rates are going up in a few years when the Trump tax cuts sunset. So all else equal, I know today I'm going to be paying a higher tax rate in the future than I am right now. So if I'm, contributing to a 401k on the assumption that tax rates are going to be lower when I retire, then I'm already, at a disadvantage there because I know tax rates are going up. Could they go up even higher? Well, I certainly, if I were a betting person, would never bet that tax rates are going to go down. I think with the current political, climate of this country and the way that we have, so much debt and the way things are going, I think most of us would agree it's likely we will see tax rates continue to rise. So again, I never bet or plan on rates being one way or the other because that's just bad planning. But if I were to bet, I can guarantee you I would bet a lot more money that tax rates are going up in the future than they're going down. So that's another reason why I think putting money in these accounts is a bad idea, because if you think you're paying a lower tax rate in the future, well, do you know that? And could we see a situation where tax rates go up to 70 or 90% like they were, several years ago in this country for those of us who are in the top bracket? So just watch out for that. Be careful when you're kind of making contributions based on that assumption. Next is that you can't take money out of those plans. There's penalties for early withdrawals. So I don't like not having the ability to access those funds. You can sometimes borrow against those plans, but I can guarantee you nobody ever does that because it's hard to do that in a way that's efficient. Usually you can't really shop around and get a good interest rate on that like you can with other types of investments that aren't inside those plans. So basically, from all practical standpoint, it is really hard to access that money in an efficient way. And that disallows you from being able to do some of our other strategies like buy, borrow, die that I talk a lot about, and just the ability to use leverage to kind of double dip and invest the same money twice. So you can't get at that money. There's some exceptions, but basically if you take that money out before retirement age, before the IRS prescribed ages where you can start taking distributions, then you pay a 10% penalty. And I've seen situations in the past where I had friends or clients that I was working with that really found this great business opportunity and they wanted to go out and buy this business, but they couldn't because they had all their savings inside a retirement account. Whereas if it had been inside that account, then they could have gone out and bought the business, and the difference in the type of, level of wealth they were able to build was drastic. Also, I've seen situations where people did use their 401ks. You can hear of like Rob's plans, like Rob's 401k plans that allow you to buy a business through your 401k. You should absolutely never do that if you can avoid that. That is a terrible result. I've worked with a lot of clients when I used to do consulting to try to get out and unwind those structures. They are just terrible. Trust me, they're really bad. I guess if you just have no other option and you just think this is a great opportunity, then maybe you do that. But you don't want to be in a situation where your only ability to buy a business or make a great investment opportunity that comes to you is by using funds inside your 401k or IRA. It's never good. It's never efficient. and it's just terrible from a tax planning standpoint. The next one, and this is one of the reasons I really, really, really hate these plans, is that there's no predictability. So when I ask people, how much money do you have in your 401k? The only right answer to that question is, I don't know, because that money is not mine. Half of that money belongs to the government. A lot of people talk about 401ks being a joint venture investment with the IRS or with the government, which I would, if I were to ever have an investment partner, it certainly would not want it to be the government. So the reason for that is that you're going to pay a lot of tax when you take those distributions from that account. And as you sit here today, even if you are, past retirement age, you have no clue what tax rate you will pay on those distributions. You have no clue what tax rates will be at the time you start having to take distributions. You have no clue how much money you will have. You have no clue how the money you're making will be taxed at that point. I see a lot of situations where high net worth individuals, particularly people who were executives at companies making very high salaries, maxed out their contributions every year, and now they're in a situation where their RMDs or their required minimum distributions put them in the highest tax bracket. You can get there really easily, especially if you've got plans with, like, let's say $3, $4, $5 million when you're getting closer to retirement age. You can easily find yourself in the top tax bracket. So if that's the case, then you just lost any type of benefit that these plans could possibly ever have. And you also have a bad result because, again, tax rates are going up, and all else equal, in a few years, they're going to be higher than they are today. So I hate the lack of predictability. I don't know how you can really plan for retirement when you have no clue how much money you're going to be able to take from those accounts, and how much, when you do take a distribution, you get to keep versus what you have to pay over to Uncle Sam. So the lack of predictability, if everything else all these other bad disadvantages didn't exist, this alone would be enough to deter me from ever using these accounts. Because if I can't plan with some sort of, certainty around how much money I'm going to have 10, 20, 30, 40 years down the road, then it's useless to me. That would make me too nervous from a risk standpoint. So the lack of predictability and knowing how much money you really have that's yours, that you get to keep, that would be enough to deter me. And I think that's a huge disadvantage of these plans. And that's let's take the time to think about the difference in a Roth IRA. So whatever money is in your Roth, that is yours to keep. You've already paid tax on that money. You don't ever have to pay another dime on that money. And so that is a great way to plan for retirement, because I know exactly how much money is in that account. Yeah, there might be, dips and increases, and I don't know, how much returns those are going to make every year. But I certainly can look back on historical returns and averages and have a good idea of how much money is going to be in that account in the long run. And I know I don't have to pay a dime of tax. So the predictability that a Roth IRA provides you is another reason that I just love those types of plans. This is something that I think gets missed a lot and misunderstood, is that 401ks, if you're, contributing to your company's 401k, that always has a fee, and those fees can be really high. And the chances are good you have absolutely no clue what those fees are. So it's very important that you pay attention to the fees from these accounts. Unless you're doing like a self-directed IRA that just has no fees, then, which is not that common, then you're paying fees, and those fees really eat into your returns in a huge way. I highly suggest you model that and see how much just the fees that you're paying to your 401k administrator do eat into your ultimate return potential of that money. I know this was a game changer for me when I read Tony Robbins' book, Money Master, The Game. That book really laid out examples and showed you the difference in your ultimate savings if you didn't have those 401k fees versus if you did. And the difference was mind-blowing of how much more money you would have if you weren't paying those 1 or 2% fees every year. Also, if you do hear of tax planning people or CPAs out there who do recommend, setting up IRAs or self-directed IRAs for business owners, for example, or investors, chances are good, I highly recommend you check if they offer that service, because in a lot of cases, they're recommending that because they want you to come use their service of setting up self-directed IRAs. And so they're the ones getting those fees. So they are financially incentivized to recommend that you use those plans and use those plans with them, because a large portion of their revenue is going to come from those fees from you setting up self-directed IRAs with them. So watch out for that. Anytime there's anyone, trying to provide advice on something, then I highly recommend you think about incentives. I have no financial incentive one way or the other to recommend you doing this. I'm completely unbiased. I don't make money on you deferring, whichever route you decide to choose. So look at that, because a lot of CPAs I do see recommend this. They might have a podcast where they do have some good tax planning advice that they give, but then they still recommend use IRAs or something, an IRA type plan, like a SEP IRA or self-directed IRA. And then I look and I see that they offer that service. So then I immediately understand why. And also be careful, because those same people will, if you do set up that plan, will tell you to put everything in it, because that might increase the fees that they can get. So watch out for fees. They are huge, huge, huge. You might think, 1% isn't that bad. Model out how bad that can be to the ultimate savings that you can have within those accounts if you didn't have those fees. So this is another huge disadvantage to me. Again, all else equal, if none of these other disadvantages didn't exist, I still wouldn't invest and put money in these accounts, because of the lack of flexibility in investment options. So I am big on investing every penny you have in the most efficient way possible. And that means you need to have access to a ton of different investment options. So yes, sometimes you can invest in venture capital funds or PE funds or even real estate funds through those accounts. But in a lot of cases, that doesn't make sense, because some of the tax benefits that do come from investing in those things are lost because you have them inside of a disadvantaged tax shelter like a 401k or IRA. Because, for example, you would never put real estate in a 401k or IRA. If anyone has ever told you to do that, I would be very concerned about, being able to trust their advice. It is pretty well established that you absolutely never want to put real estate or real estate investments in those accounts. That is because any tax benefits, and the tax benefits with real estate investing are huge. Please check out my other videos on that. It is the best investment you can make from a tax standpoint. So you lose all of that when you put that inside these accounts, because you don't get the tax benefits. You don't get the benefit of the losses, because you're not paying tax until you take distributions. And those distributions are all ordinary income. It doesn't matter the character of what comprises, the money in those accounts. So lack of flexibility investment options. Your 401ks with your company are very limited what you can and can't invest in. I know I used to work at a big four firm, and because we worked on every big company in the world pretty much, we were very limited in what we were able to invest in. So that limits you a lot. Also, a lot of times you're not going to have access to some of the best investments that are out there that are available to accredited investors and qualified purchasers through these accounts. And another reason I think lack of flexibility in investing is big here is, as I mentioned before, it's very difficult to borrow against the money inside these accounts. Yes, you might be able to, but it's not going to be done efficiently, and it's almost never done. So with that said, I don't like the lack of flexibility in investing. I like to have that money at my disposal where I can do whatever I want with it, maximize the efficiency with the way that I'm investing that money, and you just can't do that inside these plans. So the next one is mandatory return. So what I mean by this is you've got to take what's called mandatory required distributions every year, RMDs, required minimum distributions. And these are calculated and prescribed by the IRS based on the amount of money that you have in those accounts. But this means you have no control over, turning on or off distributions. So let's say, and this is a common fact pattern I've seen, where you've got a lot of people who really have a bunch of money inside these accounts find themselves in retirement age that they actually don't need that money, because they've got so much other money. They were able to save money otherwise and just build a lot of wealth that they can live off that. And so they don't need the money inside those accounts, and they don't want to take the distribution because they've got to pay tax at a bad rate on that. But unfortunately, you can't avoid that. The IRS requires you to take distributions at some point, and there's nothing you can do. You don't have a lot of control over the amount. You can't limit it. So this is one of the reasons that, you might think that you're being smart and conservative by putting a bunch of money in these accounts, but you can find yourself in a situation where these RMDs, these mandatory distributions or returns that you're required to take, that they actually kick you into the highest tax bracket. I see this happen all the time. If you've got a couple million in those plans, you can easily find yourself at retirement age, in the situation where your RMDs or mandatory returns are going to put you in the highest tax bracket. The last, and I think another really big disadvantage to these plans is that before I was really talking about income tax and how that's bad, and the income tax issues and investing issues with using these types of plans. But now I want to shift to another type of tax that's important here, and that is estate planning. So chances are good that if you're a very savvy investor and you're smart and conservative in the way that you save money and build wealth, then you're going to have, when you die and your estate passes to your heirs, there's probably going to be money left in your retirement accounts. So unfortunately, if you have money in a 401k or IRA, it is the least efficient way to pass money down to your heirs. That is because the same taint of having to pay tax at ordinary income rates that you would have had when you took the money out is going to transfer and be the same case for your heirs. So if you pass this down to your children and they inherit your 401k, in a lot of cases, they're required to take distributions out pretty quickly, and they have to pay tax at ordinary income rates. And in a lot of cases, this happens at the least, beneficial age for your children. So in a lot of cases, with just the way ages and lifespan work out, our parents die when we're at the height of our earning potential. So the last thing you want to do is give your child this money inside a 401k where they're going to pay tax at the highest tax bracket because they're already making a bunch of money themselves. And now they've got these required returns or required mandatory distributions that they're required to take on top of that and pay tax at the worst rate possible. There's also limited ability to do estate planning around, with these types of accounts. So you can, in some cases, use some trust, but if you've listened to my videos on estate planning, I hate trust other than the revocable living trust, let's carve that out. That's different. I don't really consider that much of an estate planning tool. That's really more of a probate planning tool, I guess. But from a pure estate planning, I don't like setting up trust where you've got your 401k in it and to use both spouses, unified credit, that type of stuff. I'm not going to dive into that in detail because that's beyond the scope of what we're trying to cover here. But just when you have money inside those accounts, it's the least efficient way to pass money to your heirs. And it's just really limited in what you can do from an estate planning perspective to reduce estate taxes on money in your estate, including money inside those accounts. So those are all the reasons and the disadvantages I think exist for those types of accounts. So now that I've bashed 401ks and IRAs, I do want to talk to you a little bit about the limited scenarios where I would use these accounts. So the question or the response I always get is, what if my company does matching? So yes, if that's free money, if your company's matching what's inside those accounts, then in a lot of cases, it might make sense to contribute up to the match and then no more. So if your company does do matching, maybe consider doing, contributions up to that amount and then stop at the match. It doesn't make sense to go above that because then the free money that you're getting, so to speak, from your company doesn't exist. So again, yes, if a company does matching, I would consider doing that and contributing up to the match. The second time that I would use these accounts is if you're doing what's called a mega backdoor Roth IRA strategy. And I'll put a link below to my video on mega backdoor Roth conversions and how to do those and how those work. That is a great strategy because those of us, which is a lot of us, make too much money to make flat out contributions to a Roth IRA because we're above the income limit. Then this is a way you can still make contributions and get money into a Roth. Basically, I'm not going to go into detail about how the strategy works, but you put money into an IRA, for example, and then you do what's called a backdoor Roth IRA conversion to get the money in the IRA into the Roth. You're going to pay tax on that money, but that's fine. We know, we have to pay tax on money that goes into a Roth IRA, but we're happy to do that because of the way we use those plans. Then we don't ever have to pay another dime of tax again. So that's a great strategy. Also, not only can it help you get money into a Roth if you're above the limit of the taxable income limit to make contributions, it can also help you get more money into a Roth. So, you can only put a little bit, like $6,000 a year into a Roth IRA, so that's not a lot of money. But by doing this mega backdoor Roth IRA conversion strategy that I talk about, you can get a lot more money inside those Roth account. And that's a great strategy and a great investment tool to use in the future. So I hope you found this video helpful. Again, I really consider it one of my missions in life to help educate people on how bad these strategies are. I think, unfortunately, conventional wisdom has really led us astray here. And you can't listen to the group think around these plans. There's a lot of outdated thinking involved here. There's a lot of psychology involved. You certainly wouldn't want to find yourself, at the age of 70 and realize, oh, everything I did was wrong as far as saving a bunch of money inside my retirement accounts. So I'm really speaking to those of us that still have time to adjust our strategy, that want to do more modern day investing techniques and really maximize and efficiency. Think about efficiency when you're thinking about building wealth and doing it in a way that's going to put you in the best position in the long run. So hopefully you found this video helpful. If you did, please like and subscribe to our channel.